We haven't said the word pivot, I think, the entire morning here. We'd have to go back and check this transcript. Do you see the Federal Reserve doing anything resembling a pivot in the next several months that is a catalyst for stocks here?
Well, it really depends on how we define pivot. I think right now what the Fed is thinking about is a deceleration at some stage of the future. So quite far from a pivot, which I think most people interpret as a change of direction. So deceleration certainly might be interpreted as a positive sign for stocks and certainly for the direction of rates and direction of inflation. So that's where markets seem to be anchoring right now, slowing down.
It's been a tough trade, though, right? A couple of times the market wanted to trade the pivot, and then it got whacked for doing that, right? I mean, is that a concern now that you go all in and all of a sudden the Fed turns around? And I mean, it is an interesting day coming up, December 13th, which is the first day of the Fed meeting, but also you get the November CPI report, and that could change the outlook pretty dramatically, right?
Absolutely. All eyes will be on the components of that CPI and the transmission effect of the Fed's policy so far. But I think it's important to remember that we were wrapped on the knuckles after the initial euphoria that greeted the 7.7% number. And then there was a bit of mixed messaging from the Fed. And now that seems to have really coalesced around this message of, yes, there will be deceleration at some point in the future, some assurance that this transmission is actually in effect. We're definitely going to be focused on what inflation is comprised of, whether that stickiness is still there in the service number. A lot of focus on that.
Ethan, what are you telling folks at your Thanksgiving gathering about your outlook for the economy? Because I kind of thought I knew what was going to happen. And then the last series of data has all surprised to the upside. I've seen GDP forecasts go up for the fourth quarter. Is a recession your base case here?
Not a very shallow recession, if so. We're definitely going to see a slowdown, but that's been telegraphed so well. What's really unique about this recession, if that's what it is, are two things. One is how well it's been telegraphed. We learned the lessons from the Fed. They want to get the message out there early and let it sink in. And that's what companies have done too. They got their message about rising inventory, supply chain woes, potentially slackening consumer demand out there early. And so that's one thing. And then employment is continuing to be robust. Despite these headlines from tech companies, we're still seeing at an average level, most people can have jobs, or if they want one, can get one. And that's key to restoring the consumer confidence and stability.
So is that forecast of yours, you think, baked into stocks? We had a guy in the other hour or the last segment, he said, you're going to have double-digit returns in Meta and Qualcomm and all these tech companies. So that's better than my 4-point whatever I can get in bonds because you're going to have these great returns. And I was thinking, well, if the recession's not baked in, then I'm okay. Then I may have another leg down here in stocks. What is your sense at all as to the extent to which the recession is already in the stock price?
Definitely there is a slowdown in the stock price right now. We've seen that a lot of the bad news is out of the way. I wouldn't be sharing that guest view, but the double-digit upside in some of those tech stocks. Tech is still suffering from a massive contagion effect that's still continuing to ripple from the FTX situation. We now know about the complexity there. We're looking at all the kind of adjacent businesses and anything that really involve much of this digital area. Investors now know they didn't understand it. We've seen the tourists come out of that area. And I expect tech to be affected by that for some time. I don't expect to see double digits in stocks, but I do expect to see stocks returning to their long-term run rate, high single digits, maybe around 10%. Certainly still, though, bonds are interesting. And most asset allocations are going to shift to include more bonds today. Because
what's
until
your best
bonds,
idea, Ethan, before we let you go, what's your best idea?
Best idea is defensive equities, healthcare right now. Healthcare stocks, I think I like, especially as we head into the winter.